Welcome to our 2024 webinar series. Throughout this series, we'll shine a light on three common client types that fee-only financial advisors often encounter. Follow the Green family as we illustrate the importance of lifetime insurance planning. We'll examine their risk factors and provide ways to safeguard their families and assets using personalized insurance solutions that can adapt to their changing needs throughout life. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. Today's webinar is being recorded and will be posted on our website within 24 hours. Today's presenter joined LLIS in 2003, assumed the role of president in 2008, and CEO in January of 2013. Here to talk on life insurance or inherited annuities is Mark Maurer.
Thank you, Claudia, and thank you to everybody for tuning in. Hope everybody's, I guess it's fall where a lot of you all are from. It's not fall here in Tampa, but kids go back to school and I start to see ads for pumpkin spice things, and we're still a good 2 months away from that. So welcome to fall, or hopefully you all are having a nice start to your fall. So what are we going to talk about today? Today's kind of a grab bag of a couple different things, and just kind of things that your clients may come to you with. And the first one we're going to talk about are inherited annuities. This is one of my favorite things to talk about because I like to imagine that I inherited an annuity. You know, it's from somebody who I didn't like, or even better, somebody I didn't know. So, you know, you just think about, oh, all of a sudden you get some money. That's not a bad thing to do. And it might even be likely. In 2021, and this number is probably higher by now, there was $2.5 trillion in the United States inside of annuities based on some Annuity Council study number. 2.5, not million, not billion, but trillion, the T. What were there also? There's about 65 million Gen Xers in the US who, as we talk about the great wealth transfer that might be happening here soon, assuming that everybody doesn't spend all their money on, you know, healthcare and long-term care and eggs, because that just seems to be really expensive, milk. All that money is going to get passed to the next generation, so Gen Xers. So if we say there's 65 million Gen Xers and $2.5 trillion in annuities, using probably very incorrect math, you have a 38% chance of getting $100,000 in an annuity at some point in time. Actually, it doesn't work that way at all. But if everybody, those were all $100,000 annuities, then 38% of Gen Xers would get one. It's terrible math, but makes the point that a lot of your clients are at some point more than likely, like they've got about a 4 in 10 chance of inheriting some annuity, and you all need to know what to do with them. So like I said, I like to imagine in this case that we all have an uncle, crazy uncle. Everybody's got somewhere in your family tree a crazy aunt, a crazy grandma. So I like to think about a crazy uncle who somehow, some way, shape, or form managed to set some money aside. And what he did just happened to have purchased an annuity. Over time, made $300,000 of contributions into it. Could be single premium, could be $10,000 a year for 30 years. But over time, created a $300,000 cost basis. Put money into this annuity, $300,000 of after-tax money, creating that cost basis. And when he passed away, it had not doubled, but tripled. So at death, it was worth $900,000. $300,000 cost basis, $600,000 gain to leave $900,000 annuity value. And to make numbers easy, he's going to have 3 nephews and nieces to leave that money to. So what do we need to know about this? How does it work passing money on through an annuity? One of the cool things about this annuity policy is there are named beneficiaries. There's a form. It says, who do you want to leave the money to and in what percentage? You can leave it to 3 people, a third, and a third. You leave it to 4 people at 25%. You can leave it to 4 people at 20, 20, 20, and 40% if you like somebody better. Lots of variation, but it names specific people. And the plus to this is that it doesn't go through probate. So somebody's will might say split things evenly, but you can use an annuity, life insurance, named beneficiaries to do something other than that, which you may not always want to do, but it's a very clear way to leave money to people. Very straightforward. No probate, beneficiaries, and again, because it's not going through probate, lumped in with all the other assets, it's very clear who gets what. But what to need to know about the death benefit is that it's not like a life insurance death benefit. It's called a death benefit, and people get confused that it's called a death benefit, so it'll be tax-free like a life insurance death benefit. It is not. It is not tax-free. Well, not all of it is tax-free. Annuities are great for deferring taxes in life. That's what they do. That's their bag. That's what they were designed to do. Great for that. But at death, taxes are going to be payable on any gains or earnings inside of that annuity. I put this here as an exception, annuity inside of a Roth IRA, because it always grows tax-free and it doesn't ever have taxes due. But except for that, which hopefully not a lot of your clients have annuities inside of Roth IRAs, for most of the time, taxes are going to be owed at death on the gains inside of that annuity. So if somebody leaves you an annuity, it's a good, air quote, problem to have, because one day you have an annuity death benefit that I didn't have the day before. So I'm already in a, I'm in a plus situation. It's a problem to have, good problem to have, but it can be complicated. So we're going to talk mostly about non-qualified annuities. Qualified annuities are annuities inside of an IRA, inside of a Roth IRA. And basically all the tax rules, if-then statements, roll up to whatever the IRA or Roth IRA is. The annuity inside of an IRA or an annuity inside of a Roth IRA is no different than stocks or bonds inside of that IRA, Roth IRA. The qualified plan rules tell you what the distribution is. Non-qualified annuities are slightly separate. They're a little bit their own animal. Spouse continues on as their own. No taxes due, almost like the unlimited marital deduction. You just retitle it, and if I leave an annuity to my wife, she doesn't owe taxes at death. She just retitles it, and away she goes. So really what we're talking about are non-spouse beneficiaries, like when your uncle leaves you an annuity, grandma, other things. So non-spouse. Parents, there we go, I forgot parents, that's probably the number one. Leaves it to not their spouse. What are the 3 ways that you have to distribute the money? The IRS says, the IRS giveth, the IRS taketh away. You can defer taxes in life for as long as that is. We're very generous. However, when you die, the tax man cometh. So you have 3 ways to take it out and pay those taxes that you've deferred on for 20, 30, 40 years. You have a lump sum distribution, distributions over 5 years, or lifetime distributions. And just coincidentally, Uncle Buck happened to have 3 nieces and nephews who he's going to leave this nice round $900,000 to. And amazingly, each one of them is going to pick one of these 3 different options. Who knew? Who could have seen that coming? So Harry's the favorite nephew. When you look at Harry, you might look at him and go, I think he needs money. There's just something about Harry that you kind of get that feeling. And so, or that he might be into some bookies for some money, or something like that. So Harry says, you know what? I'm really interested in that lump sum payment option. I got some guys who are after me, and I really need some money. So we can do this. He can do that. 1/3 of Uncle Buck's annuity is $300,000. Harry says, great, that looks good. $100,000 of it is cost basis. Uncle Buck's cost basis. The IRS says, well, it's money that was already taxed. No one pays tax on it again. So $100,000 of it is going to be tax-free, but there's a $200,000 gain. So when Harry cashes in this annuity, $100,000 of it is going to be tax-free. $200,000 of it is going to be taxed at ordinary income rates. And it all falls into this tax year. Like I said, some guys are after Harry, so he needs the money. But that's going to be a big, when $200,000, you're up a couple tax brackets. Let's say Harry is, I don't know, maybe a famous actor who was in Home Alone and Uncle Buck. Maybe makes a lot of money. That $200,000 is going to be taxed at even higher rates. So for some people, taking all of that right away may be okay, but it's a big thing to consider. Helpful tips. I really like this idea, especially again for like a Harry. On the annuity forms, when you claim, when you take distributions, there are options to withhold taxes, withhold estimated taxes. You don't have to, but if Harry gets a check for $300,000 and then the IRS says, next year you owe me $35,000 or $40,000 on gains, I'm guessing not everybody has you all attached to them who's going to make sure that they put that money aside to pay later. So having that federal tax withheld is a nice safety net to say, we're going to guesstimate how much your taxes are going to be, and we're going to be pretty close. But for the most part, when you get your check for $260,000, $255,000, that's going to be spendable. We've already taken out the taxes that are due. So I really like that for this, most any type of annuity payments. If you have state income taxes, I recommend doing the same thing, so that whatever check the client finally gets, distribution, is for the most part going to be spendable. So when is the lump sum preferable? I think there's 2 times. There's a large basis. If the annuity was $300,000 and the basis was $280,000, you're only going to owe tax on 20 grand out of the full $300,000. I don't think that's worth a lot of finagling for. Or it's a small annuity. Let's say the gain is 90%, but it's only an $8,000 annuity. The basis is $1,000 and it's worth $9,000. Yes, that's a lot of gain proportionally, but dollar-wise, it's not a huge number. So when we want to look at other options, we want to make sure that the juice is worth the squeeze for doing some of the other options as compared to just surrendering it and taking the cash value. So Ivan, he's our second nephew. He says, nobody's after me. No guys are after me. So I like this idea of taking the withdrawals out over the next 5 years. And great, that's an idea. So he can leave the annuity with the current annuity provider. To do that, check the fees and expenses to see if there's a better alternative that the client can 1035 exchange into. And for the most part, this is going to be the default if he doesn't do anything in the time allotted. And that time allotted can be in the 60 to 90 days after death. There's claims forms that goes out to people. So there's going to be time frames where it says, if you don't pick one of these, here's what we're going to do for you by default. This is what most commonly is. Withdrawals are taxed LIFO, last in, first out. So when Ivan goes to take money out of this annuity, the first distributions he's going to take are those taxable gains. Those gains come out first, and they're taxed as ordinary income. I say ordinary income a lot because a lot of people think annuities, life insurance, it's been a long-term, it's been around 20, 30 years. That should be cap gains treatments because it's been around a long time. It's not. Life insurance annuities is all taxable as ordinary income. So I say that over and over again, just to make sure it sticks. So here's scenario one. You'd say, Ivan, you have a $300,000 annuity. Divide that by 5 years. For the sake of my numbers, we're assuming no gains, no expenses, no nothing. We have $300,000. You're going to take it out $60,000 a year for 5 years. Nice and even. Makes sense. 5-year distribution, $60,000 for 5 years. When Ivan takes it out in equal withdrawals, the first year he takes out $60,000, 100% taxable. Year 2, his next $60,000, 100% taxable. Guess what? Year 3, 100% taxable. Gain was $200,000. At this point, he's taken out 180. Year 4 is when things start to get fun. Year 4, take $60,000. $20,000 of that is taxable. Boom, we've exhausted the gains. The next $40,000 is tax-free. And then in year 5, $60,000, 100% tax-free, if we took everything out evenly over 5 years. And this is okay. I think it's better than lump sum because there's not all that tax at once. Paid a lot of tax, probably maybe more tax than you needed to by bumping up into those higher brackets by taking all $200,000. But we're still kind of front loading the tax. So remember year 4, we exhaust the basis and then we start getting into the cost basis. At that point, there's really no reason to do it again in year 5, right? If in year 5 it's all tax free, so I might as well have just cashed it all in year 4. So a 5-year withdrawal with a different slant on it would be to take 5-year tax withdrawals. What I'm going to do here is assume paying the tax equally. So it's something like what you think you would do with the one before, but slightly different. Instead of $60,000, Ivan takes out $40,000 taxable, $40,000 taxable, $40,000 taxable, $40,000 taxable. Year 5, $140,000, $40,000 taxable, $100,000 tax-free. So here, rather than 60, 60, 60, 20, nothing, it's $40,000, a nice even taxable amount every year. And I forgot to mention, if anybody has any questions as we're going along here, questions, comments, anything, please feel free to type them in the box. I'll see them and happy to answer them as we go along. Just gonna make sure that chat box here is open. All right. Or we can look at a 5-year single premium immediate annuity. Personally, this is the one I like the best if someone was going to do 5-year distributions. So with the 5-year SPIA, it meets that 5-year requirement. It fixes the value of the annuity, so there's no market fluctuations. The $300,000 goes into the immediate annuity. That's exactly what the premium is going to be, exactly what the payouts are going to be based on. No fluctuations in it. And it does this cool thing of creating an exclusion ratio. So not only is it spreading the gains out over 5 years, it's spreading out the basis over 5 years. With an immediate annuity, the insurance company uses IRS tables on the lifetime or a period certain, just a fixed number of years, to say each payment is part return of basis, each payment is part gains. So if we did a 5-year SPIA, again, there should be some earnings. The payments would be more than $60,000, but assuming none of those things, just for nice, easy math, Ivan gets $60,000 a year for 5 years. $40,000 of it each year is taxable. So it was like our even tax distribution, or even our even tax withdrawal ones. But he's also getting $20,000 a year tax-free, instead of having to wait for that big kind of balloon payment at the end of the 5 years to get all the tax-free money out. So if somebody said, I want to spread the money, Ivan's working, has a nice income, doesn't really want to have a whole $200,000 taxable event this year, this is a nice way to get part of that $20,000 of it is tax-free, pay tax on the other 40, and spread it out over a short term. So it still feels like, fun money, but without that big lump sum in tax payments. So 5 years be better for spreading out the taxes, locks in the current value. It's simple. It is what it is. You can even set it up on annual payments, monthly payments. It will be exactly what it is. It's going to make payments for 5 years and then stop. It's done. It's predictable. Can come every month or on the same day every year. I think it's great for project clients, non-ongoing clients. Someone comes to you, especially if you're doing an hourly or a one-time project for clients, and this is why they're coming to you. It's a great option. You don't necessarily know what their taxes are and going to be able to follow them every year. It's a great option for just saying, here's a way to get the money sooner than long term, but not a giant taxable event. And especially because clients can get into less trouble than with a lump sum. You give somebody $250,000, it can go away. If you give them $55,000, they have 4 more $55,000 payments to hopefully not do what they did with the first one. And then Sarah, she's the niece. She's got a very good job. She's very tax averse and says, you know what? I don't need $200,000 this year. I don't even like the idea of getting an extra $40,000 in taxes. I have some big bonuses coming for a while. I realize I need to do something here. So I might annuitize it over my lifetime. So where a 5-year SPIA spreads the gains and basis over 5 years, a lifetime annuity does exactly that, spreads it out over her lifetime. So using these numbers, she gets $18,000 a year, $3,900 of it every year is not taxed, and almost $15,000 of it is taxable. So not $200,000 in taxes, not $40,000 in taxes, $15,000 in taxes this year. So I'd argue this one can be the best for taxes because spreading the gains and basis every year, every month, and creates lifetime income, which is always good. Any retirement calculator, things I've played with over the years, if you add immediate income or guaranteed income, like from an immediate annuity into it, even if I take X from the portfolio and use that and purchase an immediate annuity for that guaranteed income, the projections work better. May not always be a huge change, but it always moves it up a little bit higher because we're adding that guaranteed income. But my experience is no one takes this option. Why? It's just not exciting. You get $300,000, you might think, ooh, buy a cabin on the lake. That's awesome. $60,000, I can go get a new car. I think some Beamers might be under $60,000. If I get $18,000 a year, I'm thinking, ooh, that about covers my mortgage each month. Yay. Not as exciting as a car, not as exciting as a cabin. You know what? Financial responsibility isn't always sexy. So while it might be the best for taxes, people just aren't that excited. Now, one more, just to really give everybody something to think about, is a non-qualified stretch. This uses the over the life expectancy of the beneficiary language to create another option for clients. And really what it does, it uses the same IRS tax tables as for the required minimum distributions, and basically creates a required minimum distribution for an annuity. Numbers you have to take every year over your lifetime, like RMDs. But what's cool with this is we get income tax control. The numbers usually start smaller, the younger someone is. You have growth potential by leaving it in the annuity. You can have immediate access with no surrender charge annuity options. Note, it has to be an individual beneficiary. Doesn't work with a trust. Oh, question. For a lifetime annuitization, can you name a beneficiary if premature death? Absolutely. And don't get seasick while I go back to this. But yes, so if there's lifetime only, when you use the lifetime only definition, it pays for as long as Sarah's alive. There's no beneficiary because it only pays as long as she's alive. With all of the other options, it says we'll pay for as long as Sarah's alive, but minimally for the next 5, 10, 15, or 20 years. Installment refund says minimally we'll pay back what was put in payments. Lifetime with cash refund says minimally we'll pay out what was paid in, but a lump sum if they die before getting the payment back. And at that point, yes, you would name a beneficiary to say, in case Sarah dies after 2 years, using a lifetime with 10-year period certain, her beneficiary would get another 8 years of payments. Great question. All right, so with the non-qualified stretch, Sarah, who's age 60, inherits a $300,000 annuity. Using the non-qualified stretch, her calculation is just over $11,000 that she has to take this year. So what are the pluses to that? Well, it's a smaller distribution today than the lifetime SPIA. And because the SPIA was about $18,000, smallest tax now by just taking stretch distributions. $11,000, and I think the taxes on the SPIA was almost $15,000. So smallest taxable amount. Now with this annuity, she has to take those distributions come LIFO, so it's all taxable. There's no basis yet, but gives her flexibility. Let's say she's high earner for the next 7 or 8 years. I want to take out as much as possible in the next couple of years, but then in 7 or 8 years, I might speed this along. With the 5-year or lump sum, you don't have that option. With the lifetime annuity, immediate annuity, you wouldn't have that option either. So it would give someone flexibility to say, I'm going to take out a little bit here or there for a little while, and then maybe more out in the future. Because you can always take larger than those minimums if desired. Question, is there a joint option to lifetime annuitization of inherited annuity? That's a great question. I believe so. I would have to double check on that. Is a lifetime annuity choice subject to a new commission upon sale? Yes, if you keep it with the existing company, they may have some immediate annuity payouts. They're usually not as good as looking at other companies, just because they know that some people are going to take it because they don't really have any other options. And so staying within the current provider is usually not as good of deal as going out and looking to other companies. Great question. All right, so it's time to retire. So now let's get really exciting and talk about employer-sponsored life insurance. I know what you're all thinking. I probably haven't heard anything less exciting in my life, but we'll make it a little more exciting because Dr. White, Kevin, is age 66. He's approaching retirement, and he has a $2.8 million group variable universal life policy with $1 million cash value and $500,000 cost basis. Examples are always more fun when there's $1 million of something. In this case, $1 million of cash value. Makes it more interesting. And his goal for this policy is to use the cash value for retirement income. We're going to take a step back and talk about what is group variable universal life, or group UL, group universal life. Instead of traditional group term, the employer offers this group UL, VUL plan. While the employee is there, the company is paying the cost of insurance while the employee is working, kind of like just paying the annual renewable term rates for some term life insurance. But then the employee is given this option that says, I, the employer, I'm covering all the expenses. So you can put extra money into this policy and it's going to grow on a tax deferred basis, because that's how life insurance cash values grow. This money is going to grow on a tax deferred basis, and the insurance costs aren't going to eat away at it because the employer is paying for it. So a lot of people do that. At retirement or separation, the employee gets the policy. The employer isn't keeping it, the employee gets the policy. Here it is, and all the cash values. But the employer stops paying those insurance expenses. So at retirement separation, the employee now becomes responsible for these premiums that have been increasing each year. They're almost nothing when you're in your 20s and 30s. By the time you're 66, it's not small potatoes, those premiums that the employer has been covering every year. So Kevin got an illustration for his existing policy, that 2.8 million. Here's his cash value. If he doesn't pay another premium, his cash value gets eaten away by age 92, because that insurance gets really expensive when he's in his late 80s, early 90s. If you look at sort of the second to last column, he had $445,000 of cash value and $2.2 million of life insurance. Cost for that $2 million of life insurance was about $200,000 that year at age 91. So it just eats away really quickly. Remember, he said he wants to use this policy for retirement income. But if he never took $1 out, it lapses at age 92, age 93. So if he takes any money out, so if he didn't take any money out and didn't die, his $1 million just went away. He never got to use it, never went as a death benefit to anybody. If he does take money out, the policy lapses faster, and he won't get to use all of it, because the faster he uses up, the faster the policy lapses. So what are some options? Well, as Steve Miller said, go on, take the money and run. He can surrender it today. $500,000 basis is tax-free. $500,000 would be taxed as ordinary income this year. And he's retiring, but not yet retired. He's a doctor in his last year of practice, probably making a good buck. So this would not be the year to surrender it. If anything, might want to surrender it next year. Could move it into an immediate annuity. Annuitize the cash values over a fixed period of time or over his lifetime. This would be nice. It's a set it and forget it approach. But while we can spread out the taxes, because each payment is part basis and part gains, like we showed with the inherited annuity, same thing, there's a cost basis, there's a gain. We can't avoid the taxes. What if we exchange into a deferred annuity? Well, we get to continue the tax deferral and lower expenses in the group VUL, but a couple things go backwards. The annuity withdrawals are last in, first out. So same thing, we move to that annuity where you take all of your gains out first, taxed as ordinary income. And if he doesn't take out all of his gains and it passes on to his beneficiaries, now his beneficiaries owe tax on any gains. Or we can 1035 to an advisory life insurance policy. So what we want to do here is take that cash value and we want to minimize the life insurance so we can maximize the accumulation potential. Because that life insurance expenses is like any other expense. It's a drag on the earnings. So we try to reduce it to down about $1.6 million. Doesn't really have a legacy need. He says, I want to use this for income. So we want to minimize the expenses. No surrender charges with this new policy. So he has immediate access to all those cash values. And by keeping it in life insurance instead of going to an annuity, which arguably would have lower expenses, we get much better tax treatment by keeping it in life insurance. He can take tax-free withdrawals up to his cost basis. So he can take his tax-free basis out first. Can't do that with an annuity. So that's great. Then he can take tax-free loans against the gains. You can't do that with an annuity. So here's a way to potentially get almost all of the money out of the policy tax-free. Tax-free death benefit too, as long as the policy ends in a death benefit. It can't lapse too soon, but you want to have this policy end in a death benefit. As long as there's a $100 death benefit, $1 in cash value, just make sure there's some life insurance there when he passes away. So advisory life insurance also allows fee-only advisors to assist in investment allocations. By having this policy also with this tax-free option to it, you get to play with and balance where is he going to take money from this year. Taxable 401k, taxable IRA, tax-free withdrawals of some of this cash value. You get to balance it. And since you may be assisting for many years on the investment allocations, distributions, you can add the policy cash values into your AUM software for tracking, balancing, billing purposes. So we got that new projection using the same assumptions as the group variable policy. Kevin, I think he had to wait till 70, but can take $101,000 a year for 15 years, which left a tiny amount in the policy to prevent lapse, and he'll have paid zero in taxes by using a combination of distributions in the form of those tax-free withdrawals and then tax-free loans against the remaining cash values, the gains in the policy. Question, what do you mean by advisor life insurance? So there are a few companies who have designed permanent life insurance policies designed for fee-only advisors that have no surrender charges, investment options that advisors have access to, that we can work with these types of policies. And question right before it, is group VUL, UL popular? It tends to be for either your higher income executives. So as you saw, this was a $2.8 million policy. Your average worker is not going to have access to that type of policy. Many times it's the partners in a doctor's practice or executives at a large firm who are going to have those. So not everybody has them, but those are the type of scenarios, occupations who tend to have them. All right, good questions, everybody. So now we're gonna talk about existing life insurance policies. Richard's 52. Things happen in life. He has that $2 million 20-year term policy that he purchased a number of years ago. Issued at preferred rates. He was in good health back then. His wife, Adela, called. Said, Richard's been diagnosed with stage 4 prostate cancer. If you don't know much about cancers, the higher the stage, the worse it is. So this is not good news for Richard. And sometimes we get questions, this client has this policy. Is there anything we can do with it now? And it just depends on what is attached to this policy. So the first thing that I think of is, what about conversion? Conversion is the ability to trade your term policy, exchange it, trade it for a permanent life insurance policy. So I have my term policy, I might be able to exchange it for universal life, variable universal life, whole life. The reason this is valuable, when this becomes valuable, is that there are no health questions asked at the conversion. So in this case, Richard would not be eligible for coverage today. He can convert his term policy to a universal life, permanent life insurance policy at a preferred non-smoker rate class. That's the value to conversion. Whatever rate class you were issued, that's what the new policy converts to. There's full or partial conversion options. He has a $2 million policy, doesn't have to convert all 2 million, $1 million, 500,000, usually down to a minimum. Usually most companies, it's a $100,000 minimum. And conversion expiration date, that's another thing we have to look at. How long is it convertible? Usually the most common is convertible to the end of the level term period, not to exceed age 70. So you have those two kind of things you have to look at. Full 20 years, but up to age 70. Some companies say 65, some companies say 75. Some companies say it's convertible for only the first 10 years. Some companies say it's convertible for your 15-year term policy is convertible for 13 years. Your 20-year term policy is convertible for 18 years. Just depends on the company, how their term policies are done. And what's it convertible to? Some companies use a definition that say you can convert to any policies we make available for sale at time of conversion, which we can see what those are today, but what policies somebody might be able to convert to in 10, 15, 20, 30 years, it's impossible to know. So lots of different things that go into this, but finding out, is a policy convertible? What does that look like? So here for Richard, has 3 years left for his conversion option, his conversion eligibility time frame, $2 million policy. He's only paying $956 a year. So I looked at $1 million conversion, half as much of coverage. The minimum premium to convert is $11,000 a year, just over. So, and that's going to carry the policy, run it out another 11 years. That's not going to take him to age 90. That's not going to take him to age 95. So it just depends. If Richard has an 8-year life expectancy, paying $11,000 a year for 8 years to get $1 million is an amazing rate of return to protect his family. So much better than letting that term policy go after 3 years. So it just depends on time frame, what we're looking at for people. Now we here at LLIS send out our notes, our notification of term expiration emails every day. My non-scientific experience with term policies that come to the end of the term period, 10% of clients, so out of 100, 10 clients are going to let us know, hi Mark, hi Ashley, hi Miranda, yes, I'm retired, I don't need the policy anymore, I'm going to let it run out. Great. 60 out of 100, so 60% of people don't get back to us. So we're just going to assume that the need has ended, they don't need it anymore, they're going to cancel the policy, what have you. 20% of people might say, yes, I'd like to look at some options. And when they see numbers like what we had for Richard, I was paying $956 a year and the premium's now $11,000, they say pass. Want to see what it looks like, but pass. About 7% ask for some new quotes. Maybe that term policy, they're still working, didn't quite get them where they need to go. They're still in good health, so can apply for a new term policy, and it's going to be a lot less in converting to permanent coverage. 3% of people convert, usually because they have some health issues come up. And so new policies are expensive or unobtainable. We also talk about accelerated death benefit riders. There's a terminal illness rider, and this is common on most life insurance policies. Usually if it's approved in a state, just all policies come with it. And it's a similar kind of like with the conversion. You get to accelerate up to $250,000. In this case, $250,000 across all West Coast policies, or 75% of the death benefit, whichever one comes first. So in this case, if he was eligible under the terminal illness rider, he could get $250,000, which is an acceleration of the life insurance. So reduce the death benefit by $250,000. But how do you get it? You need to provide a physician statement, including the diagnosis of what his terminal illness is and reasonable medical certainty that it will result in death within the next 12 months. And basically that $250,000 is an advance, like a lien or loan on the $2 million death benefit. If he lives longer than 12 months, there's interest added to that $250,000, so it reduces the net death benefit over time. The issues, it's probably very hard to get a 12-month certainty from a physician who's willing to sign off on that. And if we did expect somebody to pass away within the next 12 months, do you want to go through that now or just wait to collect the death benefit here within the next 365 days? Just things to think about that don't make it easy necessarily. There are other accelerated death benefit options on life insurance policies. These are sort of the basic or the free ones, not talking the long-term care riders that people pay for. Specified or critical illness, this will usually pay some amount for these specified illnesses, exactly like it sounds. A much smaller amount, $25,000 or 10% of the policy face amount, whichever is less. So if this one wasn't on his West Coast policy, but had it been, it'd be $25,000 for one of those scenarios. In this case, cancer wasn't listed. Your chronic illness riders, definitions look a lot like long-term care. Older versions of the chronic illness rider may require some nursing home confinement sometimes. Larger number usually than the terminal illness, or the same, $250,000 or 40% of policy. So just depending, these are all things. If client accelerates it, $250,000, $25,000, it's added like a lien in advance on the death benefit. As time goes on, if the client lives a few years, there's interest added to that assumption, which reduces the final death benefit. Permanent life insurance, these riders, usually it's included, no cost to have if they're eligible. Term coverage may require some additional premium or rider. Sometimes the terminal illness one is usually, that's a no cost one, that's almost always just included into a policy. Lien loan exercise, interest when exercised. Those issues. Now or later, someone has a heart attack in their mid-50s. Do you want to accelerate $25,000 of a life insurance policy, knowing that $25,000 is going to grow over the next 20 or 30 years? Not sure it's worth it. Last option we're going to look at is selling it. Selling a policy to a life settlement funder. These are going to be institutional buyers, not just people who have actually just buying policies on other people, which I actually had an advisor send me a statement from a client a handful of weeks ago. I'd never seen one where they actually showed a client's percentage of interest in different life insurance policies. Life Settlements is talking to institutional buyers who are buying these in large areas, not individual people. Usually $250,000 policy size, but it's attractive to funders when we have arbitrage. Because Richard was issued at preferred rates years ago, he can convert the policy at preferred rates. But now, because his health is not near as good, the life expectancy calculation is much shorter. So the life settlement funder can pay rates like he might live to 95, but collect a premium, collect a death benefit much earlier. And so that's what they're interested in. Can I pay low rates knowing that the policy should pay off sooner than those preferred rates? So one of my first thoughts is always, if it's a good deal for the buyer, then it's probably an even better deal for the client to keep it. Because a buyer is going to have to pay expenses for doing it, and they're going to want to make a profit off of it. So if you sell it to someone, you know that there's some other charges there, where if I just kept it myself, it's probably a really good deal for my family. Or maybe it's a good deal for the kids. Maybe the kids decide to take it over. Kids decide to take over the premiums from here. Mom and dad don't want to pay the premiums anymore, but kids can take it over and collect the death benefit here in a short period of time. So those are the first places I would look at. And then if there's no kids in the picture who can afford it, mom and dad can't afford it, then life settlements may be an option. So is anyone going to be interested? This is not scientific, amazingly, but a pretty good comparison to say, is a policy of interest to a life settlement funder? The older the clients are, the more interested a settlement funder is going to be. Because remember, they're going to pay premiums until they can collect a death benefit. So a female age 82 or over, they're not going to have to pay, hopefully, or they hope, a lot of premiums because we're already age 82. If you're 62, you're gonna have to pay an awful lot of premiums over a number of years. Health, healthy senior. If someone's in good health, these are, I get these. My clients, 65, coming to end of their term policy. How's their health? Well, they're in good shape. They want to see if it's, if somebody want to buy it. More than likely, the answer is no. There's no arbitrage there. The insurance company wants to convert it at preferred rates, knowing the person's a standard table 4. Converting it preferred to pay preferred rates, there's no, in theory, that's actuarially sound. It's indifferent. So not a whole lot of chances there. Are they a smoker? You get 10 points if you're a smoker. Policy type. Joint survivorship, both alive or whole life, lower points. Term a little bit more, UL a little bit more. Joint survivorship with one deceased. There's not a lot of those out there, but that's the highest points. But a traditional whole life policy has a lot of cash. They tend to be high premium, high cash value policies. And so in order to buy it, then the funder has to probably pay at least more than what you could just cash it in for. Cash surrender value. They don't want a lot of cash value. Again, if it's $1 million policy with $200,000 of cash value, you wouldn't sell it for $100,000. You'd say, well, I can surrender it for $200,000. So they've got to pay at least $200,000 for you to even care. So low cash value is interesting. Loans are bad. No loans. Premiums. When the premiums are really high comparatively to the face amount, not good. You want lower premiums to the face amount. Total points. Again, this is sort of my anecdotal numbers. If it's under 50 points, probably not. 50 to 67 is average, and you get 68 to 100 likely that somebody might make an offer. And like I said, a lot of my calls, the client has a term policy, they're still in good health, non-smoker, mid 60s. You think they can sell the policy, and the answer is no. Of the first 65 points, they only have 6 points. So there's no way to get to that 50 and get into the even mildly likely. So older, unhealthy, that's the trigger, is that converted preferred, they're not in good shape today. So Richard Y, he, out of all those, somewhere between 56 and 61, so his might be cancer, even though it's stage 4, not always as big of a concern long term as you might think. And as we found out, Adela called later as we were going through all this. He's doing better. Hold off on any decisions, and they're going to keep us in the loop if they need us. So even there, we see it may not have been that attractive for a life settlement funder, and partly because that things can change. But before we go, just want to throw this out there. So these days, it's easy to accept and apply for a policy because people's information is current. They apply. They're doing all of most companies have an online application, all good. But later on, just as we're talking about beneficiaries, talking about people wanting to inherit, when your clients need to make those beneficiary changes, need to make adjustments, most of these, any kind of changes once a policy is in force, is going to require some verification. You can almost apply for a policy, and while you're going through the process, the insurance company's running your name through medical database checks, motor vehicle reports. They're checking it with your driver's license number, and they're assuming that you're you because you're able to provide all this stuff in the moment. But later on, they don't have a picture of the client. They don't have anything with their signature. So to make changes later on, just to make sure to prevent fraud, that somebody else isn't making these changes, they're requiring verification. Usually a driver's license is going to be just fine. Something with a signature picture. Sometimes it's a notary. Every once in a while, there's a medallion guarantee if the insurance company's being a real pain. I think I've only had that once or twice. So just so you know that many times there's going to be these requirements because we DocuSign everything these days. All of these, my electronic signature looks like the thing on top, which looks very nice. My actual one looks more like on the bottom. So if I was to actually sign something, all they've got is my DocuSign signature. They don't know if it really is me. So any of the times when Uncle Buck wants to change his beneficiaries, when Dr. White wants to change his beneficiaries, when Richard wants to make sure that his beneficiaries are right, or add his kids on as 10% beneficiaries, they didn't have documentation of their signature, wet signatures ahead of time, only had digital signatures, which are only becoming more and more common. We're having to do more verification on the back end. Just an FYI, just a one to grow on kind of public service announcement there. We have a couple conferences left this year, actually kind of starting conference season. It's hard to believe that we're already thinking about October, but we'll be exhibiting at the ACP conference beginning of October, XYPN Live mid-October, and the NAPFA Fall Conference at the end of October. And we have a few more monthly webinars in October and November coming soon: life insurance underwriting and long-term care. We work with fee-only advisors. If you haven't worked with us, if this is your first time listening to a webinar, you're new to LLIS, we save fee-only advisors time and their clients money by doing a lot of pre-underwriting to avoid surprises. We have specialists in life insurance, disability, long-term care, annuities, and hybrids, meaning long-term care, life, and annuity policies. We're proud sponsors of NAPFA Genesis, NAPFA Resource Partner, XYPN, ACP, BLX, Garrett Planning Network. Alice is our online portal where you can see your clients' quotes, annual statements for policies. Any questions? I think, Claudia, I'm a minute over my time, and I think I answered all my questions. All right, well, thank you everybody for tuning in. Have a great rest of your September. Hopefully fall has fallen on you all, wherever you might be, and we'll touch base again here next time. Thank you.